According to the Housing Affordability Index, which essentially measures average incomes versus average mortgage payments, it shows that homes in Canada have never been affordable. And that's going all the way back to the 1980s, where this metric was first being tracked. So we're going to show you where homes sit today on that affordability index. Plus, there is new inflation information out, and it does show some underlying concerns. There's an update in arrears data that we're going to talk about. And then we're going to tie it all together from the eyes of the Bank of Canada and Tiff Macklem share if the markets are currently predicting a rate cut in July or not. Plus, the July 2025 real estate stats are out for Greater Vancouver. They are hot off the press, and we are going to share the most important numbers with you so that you know exactly what is happening in the market and where it's likely headed next. Let's dive right in. Off the top, we want to talk about affordability, right? Forever the hot topic within Canadian housing. And Canadian real estate is considered to be the most affordable today, that it's been in 3 years. And it's been improving for about 5 quarters in a row. Though, when you break it down, that's not saying much. The affordability index today feels like it did around 2022. And this is thanks, of course, to lowering prices and a slight easing in mortgage interest rates. Now, how is this affordability measured? Like I mentioned, it's quite simply the median household income versus the average monthly payment, including taxes and utilities. Okay. So, quote unquote, true affordability is considered to be met when that metric of income versus the mortgage plus taxes plus utilities is at 1/3, 33% or less. Today in Canada, not just Vancouver, but in Canada, that metric is sitting at 55%, well above that ideal measure of 33%. But it is a full 8% better than we saw in the peak level of unaffordability, which hit in Q4 of 2023 at 63.5%. Now, 2 interesting facts about the history of affordability of housing within Canada. First is that in the previous peak of unaffordability, it happened in 1990, where after hitting that high, affordability actually improved for a decade straight. And today, we are right at that previous peak number that was hit in 1990. Maybe history will repeat itself and we'll see a nice fortuitous decade of housing affordability improvements. Well, maybe not, because according to RBC, they project affordability to bottom out at the end of this year at about 52% before increasing again starting next year. The second most interesting fact about affordability is that 33% or 1/3 ratio has never been reached. And we're sharing a chart here on YouTube that demonstrates that. And it goes all the way back to 1985. So in 40 years of measuring housing affordability in Canada, it's never happened. It's been close. I think it was 34%, but 33% has not been achieved. And this tells us essentially that Canadian homes have never been considered affordable. And the closest we've been, as mentioned, was about 34%. That happened in the late 1990s. And that hit 34%. We have not dipped below that number since. So, hey, if you bought a home in the late 90s, congratulations. You bought at peak affordability.
Hard to figure out when I should say, that'll ever come back. It certainly doesn't feel like it today. Let's touch on inflation here because we've got some inflation news. So inflation came in at 1.7% in May. That's largely unchanged from April. Inflation has now been within that 1% to 3% range for about the last 18 months. Core inflation hit 2.9%. It's on the high side, but it's still within that target band. And the notable contributors to inflation in May were mortgage interest costs to be exact, adding 0.4% to the total amount. And keep in mind, most countries just simply don't include this metric when calculating the CPI. So take that with a grain of salt here. But if you were to emulate that with, Canada's inflation rate, we would be at 1.3% in May. So the next largest contributor is rented accommodation, which added 0.3% to the basket. The CPI noted a 4.3% increase in annual rents in May, and Their data references appear to be lagging as rental rates have been falling for over a year. Rentals.ca points to a 3.3% decline in the past 12 months, let alone a 4.3% increase that the CPI is reporting. With record low population growth combined with a record high amount of purpose-built rentals under construction, you can expect this component of the CPI basket to lower over the coming months. And just remember, this CPI basket certainly gets massaged to the likings of those who present it.
So one thing that we've been really exploring over the last few years is the economic divide, right? There's always information that shows Canada and Canadians are struggling and in trouble. And then at the same time, there's a bunch of information that shows, well, there's a bunch that are doing very well off, like the savings to debt ratio, for example. It shows that Canadians are typically quite well off. And it's definitely important to explore both sides, right? You can't just have a narrative that says everything's going to crap or that everything's going to be okay. And here's two interesting pieces of data that kind of demonstrate exactly that divide. So employment insurance, right? EI. Right now, there are 520,000 Canadians that are receiving EI. And why that's important is because that is up almost 13% from just 1 year ago. That is a high number, and it shows how many people that are unemployed and, of course, receiving federal benefits. And where I'm leading with this is that, of course, if you don't have a job, you don't pay your bills, right? And that starts, of course, with things like your credit card, and then it works its way up to things like your mortgage payment. And the other half of that story is the arrears update, right? Who has not been paying their mortgage for 3+ months? The new information is out for April is where they've now reported. And after it improved in March, remember that it went from 0.23 down to 0.22 in March, it actually remained steady in April. So no change month over month with our most recent data. Arrears rate is 13% lower than it was pre-COVID. And you got to think, this is like 3.5 years after interest rates started increasing. We're still in a better place with arrears than we were prior to the shutdowns. And I'm continuously surprised by the level of resilience here. I thought it would have increased over at least the last 2 months, not lowered and then stabilized. Understandably, always still potential for these to spike up. But for now, extremely low levels of arrears in Canadian mortgages, even with an increasing unemployment rate and more people taking on employment insurance.
Yeah, I think we'll see in time how that, or if that changes. And to speak to that a little bit more, Dan, when you look at the business update that we're having here too, a little bit of surprise here as well. The share of businesses expected to raise their prices by more than 5% this year has dropped from 45% down to 29% in just a couple of months. I mean, logically, this would help with future inflation numbers and sheds light on a struggling economy that may be seeing some kinds of turnarounds, at least from the businesses that are trying to react to this. Companies still see some profitability without having to raise prices above the rate of inflation, but we did just talk about affordability, and I guarantee you that's on the mind of every consumer right now. So, businesses can't raise prices by too much, or they simply won't attract customers at all. So, the preliminary indicator, though, for retail sales in May dropped a massive 1.1%. That's showing that consumers are now pulling back in increasing numbers. And this is in front of, stockpiling for tariffs and things like that as well. Retailers, that is, stockpiling for tariffs. So, now seeing these consumers drop off dramatically, it's concerning, and businesses may not have the option, despite the fact that inflation is here. If the consumer pulls back, prices can't go up.
So how is the BOC looking at all this information, right? We've got housing unaffordability extremely high. We've got inflation stable, but the core inflation metrics are concerning, showing that it's likely going to increase soon. But then you've got things like rental rates and mortgage interest rates that are technically lowering. We've got more people year over year accepting or receiving employment insurance. And then we've got a somewhat stable arrears level, right? And then we've got businesses that are kind of not expecting to raise prices as much, but maybe because they can't, because there's so few people buying thanks to this retail sales numbers. So, what's a TIF to do? Well, as of right now, basically we're recording this early July the 3rd today. Happy Canada Day, belated, by the way. It seems that the markets are pricing in only a 30% chance of a rate cut on July the 30th this year. And right now, predicting only one more cut for the remainder of 2025. Over the next 6 months, only one more cut. So what does this mean for somebody about to renew or somebody who's going to consider buying? Ultimately, what you're looking at today is what you might be looking at in December, as far as what your mortgage rates look like. It might just be status quo, right? We are kind of like the market, grinding slowly to the right, a little bit up, a little bit down here and there. But again, plan accordingly, because as it seems right now, rates are going to be very similar today as they will be literally going into the beginning of 2026. Yes, lots can change, but today, that is what's forecasted. Now, let's dive into what happened with the July stats for the month of June within Vancouver real estate. As always, we start off with sales. How sick is the market, I guess, is the trend lately. She's still slow. The market, we saw only 2,186 homes sell last month. Getting ahead of myself here. Because when we look to last year, we're even slower than we were last year. And last year was a slow market, right? So we are almost 10% slower than 2024. And in that big picture, we're 26% below the 10-year average, right? It's a snail's pace out there with sales volumes. And June ended up being the second slowest June ever on record after only 2019, which means last month was slower than the COVID shutdowns. Remember, our doors were shut in April, kind of opened in May, and we were allowed to step outside in June. There were more homes sold in 2020 of June than there were last month. Okay, it is slow. And keep in mind, we are just coming off of the slowest May on record. So, if you're on the market and you've sold last month, bravo, because you are the exception and not the rule. Now, overall, we have seen sales increase for 4 straight months, obviously at a very depressed level, but they lowered in June. And it just goes to show that we are in an extreme and prolonged case of low sales volumes going on multiple years now, basically 3 years, and continuing to quote unquote worsen if high sales volumes is something you enjoy. This will all but certainly continue through our summer months, right? Like there's just no indicators anything's going to switch right now, outside of a surprise massive rate cut at the end of this month, which looks unlikely. I think we're in for a very, very slow summer, slower than typical. And realistically, coming out of this non-spring market, at this point, there's no indicators of a fall market either. Like the rest of the year could very much just grind along and hit these multi-decade lows.
It's funny, Dan, because you speak to, if you had sold last month, that bravo. And to your point, one of the properties that we helped a buyer with on our side was a single family detached home in Coquitlam. They came on the market 60 days ago at 2.5 million. We watched them for about a month and a half as they cut prices by 100 grand, then cut prices by 200 grand, then cut prices by 300 grand. And then we went in there at nearly $400,000 under their original list price to get a deal done. And I feel that's largely, if you're getting deals done, that's sort of the reality. And that's kind of what buyers are looking for. They're looking for that kind of adjustment. And it's just, some sellers, it's just not going to happen, but for some buyers, it is. Speaking of sellers here, let's look at new listings, because we hit 6,301 listings last month. That's 10% higher than June of 2024, though 5% lower than May, though that is quite a seasonal adjustment. It's the second drop in a row month over month, but we're still 13% above the 10-year average.
So how did that all result in the total inventory metric? Well, interestingly, total active inventory actually dropped in June, and it lowered for the first time in 6 months. Ended up at 16,850 odd homes on the market, lowering a full 1% from the month prior. But of course, let's go big picture. It's way up year on year, 19%. And then the 10-year average, we're still sitting at 44% more homes on the market today compared to that 10-year average. So there's a ton to choose from. Still, obviously, Ryan alluded to what happens in the marketplace from buyer expectations. Now, as always, a ton of new homes hit the market on the first day of the market, as they do. And we are now sitting at over 18,200 homes actively available in Greater Vancouver.
So let's get into the sales to active ratio here. Overall, we're sitting at 13%. It's the same month over month, though much like I just mentioned, we are sitting just above a buyer's market, which hovers in at 12%. So this is the 13th month in a row of a balanced marketplace. I suspect this could change going into the fall market, especially over the summer here. As we break it up for detached homes, they're sitting at 10%. That is inside a buyer's marketplace, and that is the same as last month. Townhomes have dropped down by 1% to 17%, and apartments have dropped down another 1% down to 14%. Overall, Dan, it appears like we're trending to the downside.
We are. Yeah, it's kind of scraping along this bottom, and who knows if it'll actually make it into a buyer's market, as that is completely the unicorn of Vancouver real estate. It's extremely rare to see the entire market go into a buyer's territory. And if it does, it almost never sustains over 2 to 3 months. So let's see, right? We're not in normal times. Anything is possible. Now, what's going on with foreclosures? As I just touched on the arrears rate essentially being stable and flat, well, the foreclosure market is emulating that as well. We only saw one single additional foreclosure month over month. So that market is still just stable. Nothing really happening, right? When I said we started tracking this in October of last year, 0.015% of the total available homes were in foreclosure. Now it's 0.016. So again, still barely on the radar here. For foreclosures, court-ordered sales, they're just not a big thing in Greater Vancouver.
Yeah, looking at days on market now, it is climbing. We are up 4 days on average to 21 days on market. So if your property is priced to market, you are typically selling within 3 weeks. Much like I mentioned earlier, if you're taking 2 months to sell, there's a good chance the pricing isn't right on your property.
So what is the right price? Well, HPI, how it's measured, the hedonically adjusted price, it dropped in June for the third month in a row, dropping $4,000 or 0.3% month over month. HPI average price for your home now, $1,173,000. That puts home prices on a year over year comparison down by 2.8%. July or June of 2024, homes were 2.8% higher. We also, of course, like to break down the two other pricing metrics to give you a more holistic and whole view. So median price, after median price increased for 4 months in a row, it actually stayed exactly the same as the previous month at $985,000. Median prices are up $70,000 year to date. And average prices increased for a second month in a row, up $9,000, sitting at $1,275,000. Currently sitting, average prices are the highest they've been in 2025 right now, and they're up $68,000 year to date. Okay, that's the data, Ryan. We're in summer. It's July. What's going to happen? How do you see Vancouver real estate over the next 2 months? Are we going to see what we normally do, it just being slow and everyone, enjoying the weather and the sun and hopefully some travel? Or are we going to flood back to the market for no apparent reason?
No. No, we're not headed back to any kind there's one of the things that I think most realtors, including ourselves, we get a good sense of boots on the ground. We'll see sort of the indicators prior to them showing up in the reports. And right now, if anything, Dan, the indicators are showing me it's going to be even slower than what we've been recording. And so, I don't think a lot of what we're going through here has washed out. Even though there's a 30% chance of a rate cut, I really don't know sort of, if the spending habits continue and continue to trend this way, that 30% could rise dramatically over the course of the next couple months, especially when people you'll see things like fuel. I think people will buy a lot of fuel because they'll be traveling and camping and doing other things like that. So we may see some of those more volatile items in the CPI basket spike up. But overall, I think Canada's economy is going to continue to grind down and to the right. And I'm not convinced that we're going to see much of a recovery. We might see a small bump in the fall, but that's about it.
Yeah, I think sales are clearly going to lower further. July will probably be like 1,800. August will be like 1,500. Like they're few and far between. Again, right, there's opportunity for buyers. If you can pick up something a couple $100K under list, that can be considered a win. Sellers, as always, you got to price to market and to take any offer seriously. Thank you, as always, for tuning in and watching. Hope you have a wonderful weekend here. Forecast looks great. Get out there, enjoy it, and come say hi at our open houses because we're going to be lonely. Thanks so much, and have a great day. Bye.